Evan, good morning to you. So what's the biggest theme, in your view, to emerge so far?
Two things: lending growth and also how stable household debt has been. And why I say that, we're only very sharply into earnings season. So we've only started for about 6 or 7 days, but most of the banks are the ones to really look at here and have reported. So need to really highlight CBA. CBA has now shown that the lending growth that they have seen in the second half of the calendar year last year was the levels that we basically were seeing just before the whole COVID crisis started. So basically January, February 2020, we were booming, housing market was booming and lending was booming, and we've now started to see that back. But what's more impressive, and this was also from Macquarie, it's also in ANZ and NAB numbers as well, is that what they refer to as bad and doubtful debts, those debts that are under pressure, those that have actually defaulted on some form of loan, business, home loan, etc., is at or below pre-COVID levels. So all of that time that we had with the, do the Australia thing and banks allowing people to actually defer payments because of hardship in 2020 and 2021, those that were under pressure from that, all of that is dissipated. And they're now back to a level that is incredibly robust, which is for something like CBA, less than 800 million of their loan book, which is over $2 trillion, is now under pressure. So that is a really, really impressive thing. And it shows that the quality is there, people are saving, people are well and truly on top of their debts, and that the expansion and more confidence they're having also came through in the numbers so far.
Okay, and what kind of pressure could higher inflation put on households, Evan?
Yeah, so that was the question that was asked yesterday of Matt Comyn when he was interviewed all day. It's also been put to pretty much every banking merchant out there at the moment. Is we know inflation is large. So particularly in the US, it's 7%. Tonight we'll actually get their January read, and that will be something to watch. Here in Australia, we too are seeing a level of inflation we haven't seen for over a decade. It is starting to show signs that it is putting pressure on middle to lower households. We are knowing that things that are referred to as the essentials, health, education, food, fuel, and also transport, they are the ones at the moment that are seeing the most levels of inflation, and that's where you spend most of your pay packet. So that would be the question, is that as households start to see inflation rise, does that actually also mean that they start to move away from being in a situation where they can handle their debt and those bad and doubtful debts we just spoke about getting higher? That will be the question to come through 2022.
Okay, and finally, Evan, what is the probability of a rate rise from the US Federal Reserve and the RBA at the moment?
So getting back to that question you just asked about inflation, that's the next question, isn't it? Is that, to moderate inflation, to sort of put it into some form of containment, you have to start thinking about moving rates to slow it down. So in the US, the expectation is that there will be 5 rate rises by December. That is fully factored in to the pricing in the market. And for March, the expectation that there could be not just one, but actually what would be referred to as 2 rate rises at once is sitting at about 67%, and a fully factored in 25 basis point rate rise is going to happen in March. So we are going to see rates rising in the US. In Australia, it's expected, according to the market, to happen by June, fully factored in that we will move to 0.25 of 1%. What's even more interesting is that the market believes by December, the cash rate will be 1.23%, which would mean that is another 4, with the possibility of almost being 5 more rate rises after June. Don't think it will be that aggressive. I think the market has got that wrong, but there is a big disconnect at the moment, and the expectation is that not only are rates going to rise, they're going to rise really, really fast.